Here are 7 things you need to do before the first of the year. Number 1, check your credit score. You don't have to have perfect credit in order to buy your first rental property or to buy a house in general, but you do need at least a 580 credit score if you're going to do an FHA loan, and at least a 620 credit score if you're going to do the traditional 3% down. Number 2, know your monthly expenses. This really only applies to expenses and things that are going to actually show up on your credit report. Those are the only expenses that a lender is going to look at. This is things like your car note, your credit cards, your student loans, any personal loans that you have, only things that actually report to your credit card. So not like your phone bill or gas bill, anything along those lines, unless it's gone into like a collections or something along those lines, they won't be showing up on your credit report. Number 3 is pay off unnecessary debt. So if you have credit card debt, I highly recommend paying those things off. They just add extra paperwork and they do affect your debt to income ratio. If you have a really high balance, then that whatever that monthly payment is on that card, that's what's going to show up on your credit and it's going to affect your income. So I recommend paying all of that off. If you have anything that's like a low balance, like a car payment or something like that, that is also kind of a lower balance that you can just go ahead and pay off, I would certainly do that, because if it's like a $300 or $400 monthly payment, it doesn't matter the actual balance. What matters is how much of the monthly is taken up out of your income. Number 4 is learn your market. So this is where you have to put your new investor hat on and you have to start paying attention to what type of neighborhood you want to invest in and then how much property is selling for in that neighborhood. As a first-time investor, if you're house hacking like I recommend you do, then you're going to be looking at single-family houses, duplexes, and then multifamilies that are up to 4 units. All of those qualify for FHA, but in regards to learning your market, you're basically just looking to see what houses or that type of property type is selling for in the neighborhood that you've selected. I would highly recommend you stay in your neighborhood that you want to invest in. That way, as you grow your portfolio, all of your properties end up being in the same area, and that makes it a lot easier for you if you decide to continue on self-managing like we do. Number 5 is get your down payment together. So as I mentioned before, you're looking at either a 3% down if you're buying a single family house, or a 3.5% down, which is FHA, and that can be a 1 single family house all the way up to a 4 unit, or if you currently have an FHA before rather, then you'll be looking at about 5% down. So wherever you fall into that spectrum, you want to have that amount saved. Also budget a little bit for closing costs. That's going to be your taxes and insurance and your inspector fees and things like that. So about 3 to 5% on that. Also, since you are still purchasing as a owner-occupied person, you still have the ability to negotiate closing costs with the person you're buying the property from. In this market, you may not be able to get all of your closing costs covered, but you can still ask for, I believe up to 6% closing costs. You'll have to correct me if I'm wrong on that, and it might differ, laws change a little bit, but point being, you can still ask the seller to kick in some closing costs for you. Number 6 kind of ties into the down payment. You'll want to make sure that your down payment is seasoned. Seasoned means that the money that you have and you intend to use for your down payment has been sitting in your bank account for about 6 months. When you do that, then the banks have everything that they need in order to just use your bank statements and not have to ask you for extra information in regards to where that down payment comes from. It's for them to try to avoid fraud and things of that nature. So just to make things easy for yourself, if that money's already sitting in your account for 6 months, and they don't have to ask any follow-up questions. Now, if you plan on getting a gift for your down payment, like your parents or a family member is gifting you the money for the down payment, then you'll want to make sure that money is over in their account and stays in their account until the day of closing. That just, again, eliminates some paperwork for you and makes it a lot easier. Okay, this part I wanted to read to you because I didn't want to mess it up. It's kind of confusing to explain, and it's easier for me to just read it out to you. So, taxes, number 7. This one's extremely important, and you'll want to make sure you plan accordingly if you want to buy here in the new year. If you're planning to make a big tax write-off purchase before the year end, you might want to hold off unless it's going to be a depreciating asset. You'll find out that straight write-offs like repairs and renovations count against your income during taxes, but they also make your income appear smaller for lending purposes. However, depreciating lowers your income for taxes, but it can also be added back during the loan process. So keep that in mind when you're getting your taxes done, because if you write off too much of the wrong thing, then your income may actually disqualify you from the loan. What it is it allows you to decrease your income to get that tax benefit, but also because it's not true cash, the lender is actually able to add that depreciation back into your income. So for example, if you renovated a property or something along those lines, or you had some other type of investment or purchase that you made from like a side business or something, and you just count that whole thing as a write-off, then that money is now gone. You've spent that cash. But if you bought, let's say, a car, for example, and you use that for your business or your side hustle or whatever the case is, then you can depreciate that car payment, and then they can add that, the lender can add that back into your overall income. So it hurts you a lot less. You can write off tons of things, and that can actually end up really lowering your income. You can make over $100,000 a year or $200,000 a year, but the lenders can only use what's on your actual taxes. So make sure you're paying attention to that. Get with your tax accountant and make sure that they understand that you're wanting to buy a property in the future. So you have to do your taxes kind of, you know, in a particular way. You have to pay to play, unfortunately. So sometimes you may not be able to use those write-offs. But the good news is you can always use write-offs later. You don't have to use them the same year that they occurred. From my understanding, I'm not a tax accountant. I'm not giving you guys exact tax advice. I'm just letting you know that you want to be very cautious with your taxes, because if you don't, then it can end up killing your deal because you won't be able to prove as much income. So that's it. That's all I have for this video. If you guys are wondering why I'm in Christmas attires, because today is actually Christmas. I'm about to go and enjoy dinner with my family. I just wanted to make sure that I got this video out. Merry Christmas to you all. I hope you guys have a great holiday, and I will see you guys tomorrow.